There is no doubt that smart money contract strategy of trading both forex and crypto market is one of the best strategies to trade crypto. But then many traders keep losing money or they keep experiencing missed entries in SMC strategies. So the best way to avoid missed entries and avoid losing your money is to make sure the order block you are using is the best one you can identify in the market. And many people who think they've known SMC or they've learned how it works still end up losing money in their trades or experiencing missed entry. You know why? This is because there's always a trap the market sets for people that don't have the adequate knowledge to trade SMC. And in this video, I'm going to show you three secrets you must have in mind before you can decide that a particular order block is the best order block you can use for any trade at all. This is a premium content I'm giving out for free, and in exchange, permit me to ask you to like this video if you found value, subscribe to this channel, click on the bell icon so that you'll be one of the first persons to be notified when I drop educational videos like this. If you are good to go, let's just get right in without any further ado. So I'll be on my system. I'll show you guys how to identify the best order blocks. I'll just mention the 3 points and then we'll look at them one after the other. So you have the 3 things you need to consider is external market structure, beginning of a wave that broke structure, and then close to fair value gap. I'll explain that in details. All right. Okay, so the first thing you want to do is to make sure that you identify your external market structures. All right, so this is where majority of traders end up making a mistake. When it comes to identifying the market structure, most traders end up trading internal market structures instead of external market structures, and it is safer to trade with external market structures. So what are external market structures? I will not go deep into market structures in this video. I just want to show you how to identify your order block. There's another video where I'll talk more about market structure, so do find the link in the description box of this particular video. All right, so let's get right in. So this is your chart. Okay, you can see the first thing you want to know is the movement of the market, and we are on a 4-hour time frame. This particular pair is H bar USDT. We're on 4-hour time frame. You can see that the market is moving in a bearish wave. Okay, so the market is bearish. Let's quickly identify the structures or the points in the market. So you can see that this particular place is a high, right? This is a high here, and then we have a low here. Okay, now if you watch carefully, you find out that there is a low here, but this low cannot be regarded as our major low. This is not a swing low because it is not lower than the previous low in a bearish move. All right, so we don't take this to be a low. Okay, so rather we go all the way down and consider I'll consider this as the next low. Okay, yeah, then I would consider this one here as my next high. Okay, stay with me. This is a high and this is a low. This is lower high, and then this is lower low, and this is a lower high. Okay, so you'll find out that in this place, this is also a high and this is a low, but you find out that this high was formed by this low. All right, that is why I don't consider this high to be my lower high, because this low is not a lower low. All right, so see what happens if you look at this particular place, this section. You can see that there are highs and lows, but all of them are what we refer to as internal market structure. These are traps that the market sets for you to lose your money. Okay, so most of the time some traders would consider this low as a low or as a swing low, which is very, very wrong. Okay, so the first thing you want to find out is identify the market structure, identify your external market structure or your swing lows and highs. All right, for this chart you can see that there is no other low that has broken this lower low until this particular place happened. All right, so I'll mark out this point as our lower low because it just broke this low. All right, so let me mark out these 2 points so that you understand what I'm talking about. So before you do anything, you mark out this swing low Let's do that. So this is a swing high. Okay, this is a swing high, and this is a swing low. Let me mark out the swing low. All right, and this is a 4-hour time frame. So in choosing the right order block, you must make sure your order block is located at an external market structure. All right, so at this point, our order block has to be located somewhere in this lower low if you're taking a long trade, or somewhere on this level of the lower high if you are taking a short trade. Okay, so we'll go to a lower time frame and see what's happening at lower time frame before we can identify the best place to pick as our order block. Okay, so this is 1 hour time frame. So if you look at this 1 hour time frame right now, more lows and highs are formed. Okay, so you can see that this lower low here and this lower low here, they have the same point, and it has been broken at this point. So we want to look for an order block that has not been tested at all. Okay, now the first thing we want to do, while this might be a bit difficult on this particular trade, is because the market is ranging, and it's been ranging for a long time. Okay, it's been ranging for a long time. So if you were to wait for the market to come to this point, for instance, let's say for instance you want to take a short trade, okay, like you want to sell the market, right? This is where you pick your order block because it is located at the market structure. But that's not the only thing you consider before you pick an order block. Okay, so let's go down into 15 minutes time frame and see what's going on in 15 minutes time frame before we now look at the two other points you must consider in picking your order block. All right, so at the 15 minutes time frame, I'll look at what's happening at the internal structure just for this 15 minutes time frame. Most of the time, before you trade internal market structures, it is when you want to do scalping, when you want to trade for long. All right, but if you want to hold your trade for long, you want to go for external market structures. All right, so if you look at this, the second point you need to consider when choosing your order block is base, or the beginning of a break of structure. All right, so we look at this, you can see that this particular chart is bearish, like we've seen. Okay, so it's bearish. Want to identify a break of structure. Okay, so in a bearish trend, you want to trade along the trend. Okay, so you look for a sell opportunity, but if you must go for a long opportunity, you have to look for break of structure. All right, so from here, let's quickly look for a break of structure. Okay, all right, so let me work with this. You can see that the market was coming down on a bearish move, bearish swing like this. Okay, and then there is, you can see, this is a lower high, this is a lower low. All right, the market's supposed to continue going down, but we find out that the price moved, retraced, and moved more than this high that is here. All right, and moved and broke a structure here. So when this happens, you can say that a structure has been broken here, right? The same thing is also happening here. You can see that the market from this point came down on a bearish move to this point, but instead of continuing down, the market did not. This is a lower low here, but this particular low here is not a lower low, so the market is trying to change direction. Okay, so because of that, you see the market breaking structure. All right, so this is a high, this is another high, a lower high, right? It's supposed to form another lower high. We can see that the next high broke the previous high. That is what we call a break of structure. All right, so let's mark out the break of structure that happened at that point. So you can see there's a break of structure here. All right, so what happens is that when this break of structure happens, you look at the base with the beginning of the wave that broke the structure. That is where you mark out your order block. All right, so then if you want to mark out your order block at this point, For a long position, if you want to long the market, you come down to the base of the order block or the base of the wave. How you pick your order block is the last red candle that formed before the green candle that began the wave that broke the structure. So at this point, you find out that the at this point you can see that the last red candle is this one here, right? So you move from there and pick your order block from there. All right, but if I'm to fine tune that, I'll quickly go to 5 minutes time frame and fine tune, just to make it finer, fine tune it so that it will be more effective. Okay, so this is 5 minutes time frame. We can see that I will have the last red candle that traded before the market began to go bullish. All right, so I reduce my order block to the last red candle at this point. Okay, now that is the second thing you consider. But for us to decide if this order block is the best point, I told you it must be the beginning of a break of structure. We have identified the external market structure and we've also identified the beginning of a break of structure. So the third thing is that before you choose your order block, it must also tick the box of fair value gap. There must be a fair value gap around it. Okay, so how do you identify a fair value gap? So this is how you identify fair value gap. When you have three candles trading, for instance, let's do this. You have three candles like this at this point, somewhere like this. Okay, value gap simply means the distance between the tip of this first candle and the base of the third candle. Let's mark that out quickly. This is the base of the third candle, and then we'll mark out the tip or the head of the first candle. So when this happens, the distance between the two, this distance here is your fair value gap. Fair value gap simply means that there is an imbalance. When you see three green candles forming like this, it means that the market has experienced an imbalance and the market must return to come and fill up that imbalance. So market moved from here, market moved like this, all green candles, and moved to this point. They are all green candles. What happens is that there's an imbalance that the market must come back. Market must retrace into the fair value gap, either at the tip or somewhere inside the fair value gap. It will touch it and then continue the upward movement. All right, so what that means is that the market is trying to come and fill this gap before continuing in the movement. So for everywhere you see fair value gap, you have to expect a retracement of the market back into that gap to fill it up before continuing in the direction. So this happens when the market is bullish, and the same thing happens when the market is also bearish. When there are red candles, three red candles are formed, provided that the tip of the first does not coincide with the base of the third one, there's always a gap there. The market will most likely return back into that gap before to continue trading downwards, because it's a bearish movement. All right, so we are saying that for you to choose the best order block, there must be a fair value gap around the order block. Now for a long trade, the order block will be found below the fair value gap, and for a short trade, that's for a sell trade, the order block has to be found above the fair value gap. All right, so for this diagram I just showed now, the order block will be this. Let's take these three candles as green candles, right, for a bullish market structure. Now the other block is going to be, we are going to locate a candle that I told you, the last red candle that traded before the green candles began to appear. Okay, so let's call that candle, let's call it red. All right, that's, yeah, a red candle. Okay, now this is a red candle, right? So this is where we'll pick our order block from. Now we'll mark it out like this. Okay, and that becomes our order block. All right, let's give it real color. Okay, so as it is there, as it is now, this area is our order block because it is below the fair value gap. All right, so what that means is that the order block is more likely to be respected. The market will more likely come into it because if not for the, apart from the order block, the fair value gap is also drawing the price down, so there's every tendency that the price will come down. So if your order block is located above the fair value gap for a long trade, the market will most likely hit your stop loss, okay, and still come down a bit before going up. That is why you must make sure you place your order block just below the fair value gap, and then from here you can find your entry. All right, let's say you can now take your long position, from anywhere in the order block if that is your strategy. Okay, but for me, in another video I will show you guys how to avoid missing entry. For this video I'm just showing you the best way to pick your order block. Okay, so this is how to pick your order block. Make sure you identify the external market structure, work with external market structure, then identify the beginning of a wave that broke structure, and then the third one is try to make sure that you choose your order block that is close to a fair value gap. So let's try to identify an order block that is close to a fair value gap. Okay, all right, so let's check the chart. Let's try to see if our order block respects that rule. Now for this particular order block, this is 5 minutes time frame, so let's check a higher time frame to see if there's a fair value gap around that. Okay, so let's check 1 hour time frame. In a 1 hour time frame, this is the order block here, so it doesn't, so you can see that there are two green candles here and a red candle in between, so there's no fair value gap that happened there. But a typical example of a fair value gap is what we see in this particular place. You can see that there is a gap, right? You can see that this is the base of the third candle, this is the third green candle, this is first, second, and third. All right, and then we'll mark out the tip of the first candle. Okay, mark out the tip of the first candle, and when we've done that, you can see that, let me remove this, you can see that the market traded into that particular fair value gap. So you can see that the market retraced into to fill this gap, but the buyers were not strong enough to continue pushing it up, so the market came down further down. All right, but the most important thing is that the market respected the fair value gap rule, came down to tap into the fair value gap. All right, so for this particular example, this is a fair value gap. You have to find another block that is around the fair value gap, but for most cases, if you get 2 out of these 3 factors, your other block is good to go. But if you can get another block that ticks these 3 boxes: external market structure, base or beginning of a wave that broke structure, and then fair value gap around the order block, to give you more results in your trading. Okay, so guys, those are the 3 things you must find out. Then another bonus point is liquidity. Okay, let me go to 15 minutes time frame to show us liquidity. Okay, so as you are choosing your order block, you make sure your order block is also below liquidity. All right, for a buy trade, and then above liquidity for a short trade. Okay, so let's identify our order block on 15 minutes time frame, and let's see if we can identify the point of liquidity. Okay, the liquidity simply means a particular point where there is a concentration of a particular action, buy action or sell action. Okay, so in this chart now you can see that this point is a liquid, this is our order block here. This particular point is a liquidity point where money entered the market. All right, so your order block must be below the liquidity, because the price is going to come down to take off that liquidity. It will trade below the liquidity before it continues going up, and you can see that that's what the market did. The market came down, tested our order block, and started moving up. It came down again and tested the order block, and then started going all the way up. All right, so if this is your order block, you want to take your trade from there, okay, and then ride all the way to the next high, okay, either here or here. You can place your stop loss somewhere just below the order block so that you don't get to risk a lot of your money. Okay, that is one effectiveness of smart money contract. So for this trade, you can see that we are risking 0.8% to make 3.707% profit. Okay, and if you're a futures trader in the crypto trading space, you know that you can use leverage to increase this percentage in profit or in loss as well. Okay, so guys, that is it for that. If you found value, don't forget to like this video, subscribe to my channel, and then click the bell icon so that you get notified whenever I post new educational videos. If you want to know how to trade or you want to get free signals from me, find the link to my Telegram community down in the description of this video so that you join my community. I share free signals and also tips for trading. And I see you in my next video. Peace out.